So the third point is distinguish absorption from variable costing. Okay, so what's the difference between these two types of costing? And we want to understand what the differences in the operating income under the two different costing. Okay, so this number 3, it will be the most important focus for today's lecture. And for appendix A and B, there are some very interesting topics here, but we probably don't have time to cover it. If you had time, just read it. Some of them are pretty straightforward to read. I will briefly talk about, there are 2 slides, I think, about the appendix. Okay, so the denominator level process. So I'm just going to go through here right away. Okay. Okay, so this is what we are talking about. So basically, for the corporation, we know that they have manufacturing overhead, right? Some of the overhead is fixed, right? Can someone give me an example of a fixed manufacturing overhead cost? For sure, Robert.
Utilities.
Utilities? Sure, yeah. I can definitely see the fixed component of utilities, right? Maybe the utilities also have a variable component, right? The more the more productions you are making probably cost more utility, right? Who else is here? Just give me 1 second. Okay, Natasha?
I was going to say rent.
Oh yeah, factory rent, right? If you rent a factory, so you are paying like a fixed amount of fee, right? Every month, regardless of the level of the production. Yeah, very good. Okay, so we're talking about the fixed manufacturing overhead, okay? So we know the total amount of the cost, right? And then we need to figure out, right, a rate, right? A rate based on the level of activity, right? So previously we have talked about, this is something called a predetermined manufacturing overhead rate. Remember that, right? In the earlier chapters. You learned this even in the 2400. Okay, so in order to find out the rate, okay, you're gonna use the cost divided by a level, right? A level of activity, right? So that level of activity is sitting at the denominator, right? So that's what we are talking about, right? So we are talking about, okay, so which denominator we're gonna use, right? So normally it's a level of production, or something like that, right? The output units, right? So there are different candidates for that denominator, okay? There are different candidates for the denominators. You can think about it from the supply side, right? Supply side. So if I pay a rent, right? If I pay a rent, so I open a restaurant, right? The fixed manufacturing overhead is, I say, $5,000 a month. So I rent a place to open a restaurant, okay? Okay, so what is the capacity, right? In terms of the production, right? In terms of, well, I can go 24 hours, 7 days per week, right? Right, I can, this is the possibility, right? I can make it run 24 hours, 7 days per week, right? Just keep the vacation going, right? Keep it running. Okay. So that would be something kind of like a, like ideal situation with no delays, no shutdowns, even Christmas, right? I will run it 365 days a year, right? Even Christmas, even like different holidays, right? I will still keep it going, right? So if there's no delays, okay, no shutdowns, right? So in an ideal situation, I can keep it running like 24 hours, right? 7 days a week, right? And 53 weeks a year. So that would be a theoretical capacity, right? That's how many hours, right? If you're talking about maybe the labor hours, right? The level of the labor hours as the denominator. That's how much I can supply, right? Theoretically, right? Practically, and then you want to think about for shutdowns and the maintenance inspections, right? So maybe the government, they need to inspect your location, your working environment, right? They want to check to make sure your kitchen is clean enough, right? You are not providing bad food, right, to the customers. And then the machines, right? You have to maintain the machines.
Reward Center. We appreciate your business.
Okay, so can somebody please mute yourself? So who is this student?
For merchandise, gift cards, and other rewards, press 2.
Just give me a second. I have to mute this student.
Thank you for calling the CIBC Reward Center. Our office is currently closed.
Okay, Sandeep, you have to mute yourself, okay?
Busted.
And Inga. Okay, now we are back. Sorry, guys. Okay, so where I am talking about. Okay, so practically, right? You have to. It's just not possible to keep the machines running all the time, right? And maybe your chef need time to take a break, right? And so those would be practical capacities, right? But practical capacities will be lower than the theoretical capacities, right? So this would be from the supply, right? In terms of supply, right? The story. But from the demand, right? So from the demand, if I open 24 hours a day, do I have clients? Do I have customers to come there to eat, right? Probably not, right? Probably people eat 3 meals a day, right? Mostly they are, maybe lunch or dinner, right? So even though you can open as long as you want, that's your business, but you probably don't have any customers, right? So therefore, when you talk about capacities, you should think about from the demand side, right? The demand side. So there are 2 capacities. One is called the normal capacity. The other one is called the master budget capacity. So for the normal capacity, it's an estimation based on an average of a longer period of time, maybe a couple of years, okay? For the master budget capacity, this is just for one period, okay? You have certain amount of capacities to satisfy customer demand for one period, okay? So in terms of the regulations, okay, the IFRS and ISB, this is the accounting standards, right? They will regulate to ask the accountants to use normal capacity, okay? When they are calculating this overhead rate, they have to use normal capacities, okay? So this will be compliant with the IFRS and ISB. In terms of tax requirement, the CRA, they want you to use the master budget capacity. Okay, so this will be, the customer demand, right? In 1 year, right? In this 1 year period, how many labor hours, right? I have to make sure I have enough labor hours there to satisfy my customer within the 1 year, right? And the normal capacity would be in a longer time window, like maybe 2 years or 3 years, okay? Then what would be the average, okay, of the customer demand, okay? So basically, the reason why IFRS and ISB wants to have an average of a longer window term is because that some business, they can fluctuate, right? The business sometimes could be seasonal, right? they are really busy in the summer, right? High labor hours demand, right? And then in the other reason, maybe tourism, right? They are really busy in the summertime, but slows down in the wintertime, right? So for the IFRS and the ISB, they are trying to get an average, right? For a longer time window. They try to know the average capacities, right? So if you really think about it, that's a very good question, right? When I'm calculating that overhead rate, right? Which number I should use for that denominator, right? So that's a very valid question. So these slides provide us some very important insights. So basically, to stick with the IFRS of ISB, you have to use the normal capacity, okay? Do we have any questions on this slide? Will you run your restaurant 24 hours?
Denny's used to.
Pardon me?
Denny's.
Oh, yeah. Even right now, the fast food restaurant, right? Like McDonald's, right? So they are able to do that, right? But for those, let's say, CAG, right? Let's say, those other Boston Pizza, right? Those kind of restaurant, they probably won't open for that long, right? They are pretty targeted at a certain time, right? The dining time. Summary?
The CRA under the normal capacity, it's a mistake. Then CRA doesn't not accept this, right, for the long term.
CRA doesn't accept for long term, right?
Yeah, so this is not okay.
Yes, the CRA has to be a short term, right? Yeah. Okay, so let's move on. Okay, so this picture is very interesting. So I just want somebody, if you have reviewed the textbook, maybe you can explain what does this picture tells us. For those of you who have already read the textbook before the lecture. I'm giving you an opportunity to teach the other classmates. Yeah, I regret for saying that because now you are really under the pressure. Natasha?
I can do it. I'm
Okay.
going to be honest, I didn't read the textbook, but I can explain it. So essentially with your units of output, when a company first starts, like during the development, beginning foundation stages, like it's lower. So like as the company grows and it increases, you're going to see more growth. Like once you advertise your market, you're going to get more inflow of like output as you increase your business and units of output. And then you're going to max out like peak. Once your demand keeps going up, you're going to mature. Your maturity is when it levels off at the top.
Yeah.
And then like the saturation, then slowly it will decline.
Yeah, very good. Yeah, that's basically the life cycle for any business, right? Okay, so that orange curve, that's basically how the business developed, how the units output has increased, changed, right? What about that dashed line? There's a dashed line on top of the orange line. Anyone wants to try that?
The semi-fixed capacity visual representation represents the presence of production.
Sorry, I cannot hear you, Jeremy.
Opportunity cost of being unable to meet demand.
Okay, yeah, you were cut off a little bit in the middle. So basically, the dashed line is the supply, right? Is the supply of the capacity. So it's very interesting if you see that this supply is a series of the step functions, right? This go up, right, and then stabilize, and then go up, went down, stabilize, like steps, right? So basically, when you are growing your business, right? When you are growing your business, these units of output will, the ability of the units output has to increase, right? So in the beginning, you only have 10 customers, right? So every day you probably only manufacture 20 dishes, right? But then, okay, when the business is growing, right, you have more customers coming, then you need to have more capacities. You have to be able to produce, you have to hire another chef, right? So now your units of output will increase from 20 to 40, right? Because you add another chef, right? And then, you have more customers, right? You have more customers coming in, and then, you're just getting more busier, right? And the units of output is increasing, right? You can see this curve. The demand is increasing. So that means you have to provide enough supply, right, on your side. So therefore, you have to keep investing into the resources, right? And interestingly, that those resources, it's not continuous, right? You invest into the resources, okay, and that capacity is good for some time before you have to upgrade again, right? So that's why you see this shape is the step function, right? Each time there's a higher step, that means you are investing into more resources to increase your supply, right? The capacity supply, right? The gap between this dashed line and this orange curve line, the gap, that's the production volume variance, right? Basically, your production capacity is greater than the demand, right? Why? Because you are trying to play safe, right? There are some costs, right? There are some costs for having those additional, keeping those additional production capacity, right? But that cost will justify for the benefit because you always satisfy the sales demand, right? So you are able to take sales, right? So sometimes if you take a look at certain targets, right? When Targets came to Canada, this is a retail supermarket. It's very popular in States, right? So many years ago, they came to Canada. I was very bad because they were very successful in States. They think they can replicate the success in Canada. But if you go to that supermarket, you notice it's empty shelves everywhere, right? So basically, right, they have some logistical issues, right? So you can see that they are not be able to meet the demand, right? Many people go there, they want to buy, but they don't have the stuff, right? So therefore, it's important you want to meet the demand, right? But if you want to always meet the demand, that means you have to keep investing your production capacity to make sure it's always greater than the demand, right? Than the demand. Does this make sense?
Yes.
Okay, good. So now let's keep moving capacity. Okay, so I just want to give you some example here, okay? So there are different capacity concepts. P here is a theoretical, okay? P is practical. So this two is from the supply perspective. And then from the demand perspective, you have normal, you have master budget, okay? That's the four different potential candidates for the denominator, right? Let's assume the budget fixed manufacturing overhead per month is $40, okay? And the capacity for theoretical, right? This is the largest, right? Is 10 units. Theoretically, I can make 10 units per month, okay? Practically, I can probably make 8, okay? Because there are delays, right? There are inspections, maintenance, right? So that's the time, the idle time, right? So that's why it's lower. So theoretical is always higher. The theoretical capacity is always higher than the practical capacity. Okay, and then you can see when you calculate the rate, you are using the cost divided by the level, the capacity. So 40 divided by 10, that's $4. 40 divided by 8, that's $5, okay? And now let's take a look at the normal capacity. We are saying over a couple of period, the average of the capacity level to meet client's demand is 5. Okay, so on average, every month, customer will buy only 5 units. So 40 divided by 5, that's $8. And this master budget capacity is 4. Let's say in this quarter, okay, every month there are only 6. They only be able to sell 4, right? The demand is only 4 units. So 40 divided by 4 is 10. Okay. So tell me when the capacity level went down, what happened to the rate? So if the capacity level you used is lower, what happened to the rate?
Increase.
Mikiko?
Goes up.
Goes up, right? You can see when the capacity level from 10, 8, 5, 4 going down, and the rate is going up 4, 5, 8, 10, right? Okay, so if the rate is going up, this is the fixed overhead, right? Rate go up, then the product cost will go up, right? The product cost has 3 components, right? Materials, labor, and overhead. And overhead can have 2 components, variable and fixed. If your fixed overhead rate went up, your product cost will go up, right? Okay, you can see, you know, the choice of this capacity level really affects a lot of other things, right? Okay, so let's keep going. Okay, here's my question. Using theoretical or practical capacity as the denominator, what amount of fixed manufacturing overhead assigned to the inventory? So when you use these levels, capacities, is that it going to reduce or increase the amount of fixed manufacturing overhead assigned to the inventory? Reduce, right? Because so the theoretical practical capacities, okay, if you take a look at the theoretical and practical, these rates are lower, right? 4, 5. When the rates are lower, right? When you allocate the overhead to the inventory, to the product, that rate is lower. Therefore, the cost will be low, right? To allocate to the inventory. Okay. And that's going to increase the production volume variance. Okay. That's going to increase the production volume variance. Why? I'm going to show you. Okay. So what is the production volume variance? Okay, what's the production volume variance? If you have seen these pictures, right? You see this graph. We always have more production capacities than the demand, right? So that is what we mean by the variance. Okay, so how do we calculate this variance? So the variance, production volume variance, equals the budgeted fixed overhead cost minus actual output units times budgeted fixed manufacturing overhead rate. Okay. So for example, let's assume that we are using the normal capacity, 45.8. The actual output is 4. Okay. So what's the production volume variance? Okay. So what's the budget cost? The budget cost fixed overhead cost is 40. Okay. So that's this one. Minus actual output. So that's 4 units. And the rate, we are using normal capacity. The rate is 8. So 4 times 8. Okay. So 40 minus 32 equals 8. So in this case, the production volume variance would be $8. Okay, would be $8. Why? Because you think it's 5, right? Your budget, you think that's 5. That's normal capacity, but the actual is 4, right? So the variance, the difference is 1 unit, and each unit is $8, right? So that's why this is the $8 variance. So that's the performance variance. So when your rates are lower, okay, in this formula, when this rates, okay, the budget fixed manufacturing overhead rate, if this number is lower, the production volume variance will be higher or lower?
Higher.
Higher.
Higher, right? Because there's a minus, right? So a fixed number minus actual output units times the rate. When the rate is lower, this number, the variance will be higher, okay? So that is why we are saying when you are using the theoretical or practical capacity, the rates are lower, and that will increase your production volume variance, okay? Okay, so let's see if now you really understand this. If you are able to get correct this 3 box, you should be okay. Yeah. Let's see. So generally, the lower the capacity, that's the denominator. If that capacity amount is lower, what is going to happen to the fixed overhead cost? Lower or higher? Lily?
It's going to be higher.
Higher, thank you. Yeah. What about the cost assigned to each unit reproduced? Green?
Is that one going to be higher as well?
Hayden?
That should also be higher.
June?
Yep, higher.
Sharon?
I'll say higher.
Okay, yeah, that's correct. Yeah. What about the production volume variance? If the capacity is lower, what happened to the production volume variance? Samarine?
Lower.
Lower? That's right, because that's the only one left. Okay.
It'll be lower.
Yeah. Okay. So why? Because your rates is higher, right? So if the capacity is lower, your rates is higher, right? In that formula, okay, in this formula, right? If this rates is higher, right, and multiply number, this together will be higher, and there is a minus in front of it. So this will be lower, right? So the production volume variance moves opposite direction as the budget rate, okay, budget rate. So if in the final exam, I ask you a question like this, do you think you'll be able to answer it?
Yeah, we'll all get 100%.
Okay, good.
50.
Good. So why don't you mark it down, saying, it's interesting. When I was a student, I'm really good at with listening to my professor's hint, right? If my professor says something about this, I will put like 5 stars on, just on this slide, because, okay. So in the final exam, if there's a question similar to this, make sure you understand, right? Okay. Are we okay with this? Okay. Okay. 1, 2, 3. If you are okay, please sum up. Okay. Awesome. Thank you. Okay. So I don't want you to be confused. This is the production volume variance with the other variance you learned from last chapter. Okay. So the best way to know this is just to remember this formula, right? because we do learn about some kind of sales volume variance, right, in the previous chapter. So don't be confused with those two, right? So how are you gonna distinguish them? Just remember how this is calculated, right? The production volume variance, that's the budgeted fixed overhead cost, minus the actual output units times the budgeted fixed manufacturing overhead rate. Okay. Okay, so this is a very interesting point here. So if you use the master budget capacity, this can cause a potential problem, right? Remember, we talked about normal capacities, right? So that's kind of like an average of a long-term window, time window. The master budget capacity can lead to a downward demand spiral. So what does this mean? Okay, what does this mean? So suppose when the sales decreased, okay, because of economy is not doing well, okay, COVID, anything else, so the sales dropped, okay. If there is this situation, the sales dropped, then what happened to the master budget capacity? So if the sales decreased, can you tell me about the demand? If the sales decreased, how does that speak of the demand from the customer? I will call somebody who haven't answered, okay? Yufeng?
I think it will decrease.
Right, so the customer demand decreased, right? So what about the short-term master budget capacity? So the master budget capacity, that is for the short-term, right? The customer demand. So this one should be increased or decreased here?
It also decreasing.
Decrease, right? Very good. So this decrease, right? Why? Sales decreased. That means the customer demand decreased. So the capacity, the short-term capacity, the master budget capacity, that reflects the customer demand within a short period of time, right? So that decreased. If this number decreased, what happened then? What happened to the rate? So if that denominator, the capacity decreased, what happened to the rate? Yinda?
It increases.
Sorry, say that again.
Yeah, it increase.
Increase, very good. So this is decreased and it's on the denominator. So your budget fixed overhead cost per unit will increase. Okay, if that rate increase, what happened to the product cost per unit? Giovanni?
Increase.
Increase, very good. So that increased, okay? So if your product cost increased, what happened to the sales price? Okay, see who has the answer yet. Bianca?
Sorry, you asked for the sales price, right?
Yeah, for the sales price.
It should increase.
Yeah. So your product costs you more, right? So you have to increase your price, right? Because the product cost is more, right? You want to increase your price, increase your selling price, and then what happened to the sales? Now your price is higher. What happened to the sales? Oops, sorry. Well, you can see it now. So the sales further decreased, right? And this is the second round. Did you see? This is the spiral, right? This is the spiral. Do you see why it's called a spiral? So the sales decrease first round, and then you see this spiral going around, and the sales further decreased, and then it starts the second round, right? And so this is just going like in the spiral, right? In the spiral. Okay, so does this make sense?
Yes.
Okay, 1, 2, 3. Okay, okay, very good. Yeah. Okay, so this is a potential problem, right? When you use the master budget capacity, when the sales decrease, price decrease, when the sales volume decrease, that caused is called downward demand spiral. Downward demand spiral. So it just the demand for your product just going down, right, in the spiral. Yeah. Okay, when you use normal capacity, okay, you use normal capacity, it provides no meaningful feedback on performance. Why? So why? You know, sometimes we need to evaluate our employees, staffs, right? Why this normal capacity does not provide meaningful feedback? If you finished in 3 months, right? You finished this course, right? And when do you hope to get feedback for your course, right? What if I give it to you 3 years later, the feedback about this course? So when you use normal capacity, okay, it provides no meaningful feedback on performance. Why?
Because there's no fluctuations in time.
No fluctuations in time. Okay, yeah, you're getting there. Yeah, I see what you are trying to say. It's close.
The information's not relevant by the time it gets to you.
Okay, yeah, it's
not
about
helpful.
timing, right? Yeah, it is about timing. So basically, this is average. The normal capacity is about average over several years, right? Performance has to be assessed more frequently, right? Right? So in that case, you want to use the master budget capacity, right? You should not use the normal capacity because this is the average over several years, okay? Okay. So now this is the inventory costing choice. This is the most important part, okay? I think in the final exams, there will be questions on this. So I want to give you 2 scenarios. Now you can think about what should I debit, okay? So if I, in accounting, right? If I credit cash, what can I debit? Give me 2 scenarios. So why credit cash? Does that mean I'm spending money or I'm receiving money if I credit cash?
You're spending money?
I'm spending money, right? And then what should I debit?
Product inventory?
Inventory? Yeah, you spend money, you buy some inventory, right? Okay. What else? Anybody else? That's a scenario 1. Scenario 2. So you can use cash to get inventory. So you debit the inventory. What else you can do? So Rain?
Couldn't you, you could potentially buy any asset or any equity driver?
Yeah, just like inventory is asset, right? Okay,
Yeah.
so what else you can do? Credit cash, debit what?
Expensive?
Expenses, right? Debit expenses, okay? So the difference is expenses will be recorded on income statement and the inventory will be recorded on balance sheet. Okay, you have learned 2100, okay? So I don't have to speak more about that. Okay, so with that, we want to talk about these 2 costings, okay? Variable costing. So what is variable costing, okay? So variable costing, basically, you only, okay? You only record all the variable manufacturing cost as inventory. Fixed manufacturing costs are expensed. So if you remember, what happened is for the manufacturing manufacturing cost, it first goes to the inventory, right? You remember that we have a work in process inventory, right? You have a beginning balance, then you add direct material, you add direct labor, you add manufacturing overhead, right? And then once that item, the product is manufactured, you remove cost of goods manufactured to the cost of goods sold, right? Sorry, to the finished goods inventory, right? And when you eventually sell that goods to the customers, that became cost of goods sold, goes into the income statement. Okay, so the manufacturing cost first goes to the inventory, okay, and then it's sitting in the finished goods inventory, and then it goes to the income statement only after it was sold in the form of cost of goods sold. Okay, here for variable costing, you treat fixed manufacturing overhead cost as expenses, which is a period cost, not product cost. Okay, so I will say that again. Under variable costing, you treat fixed manufacturing overhead cost as a period cost. So that goes to the expenses, go to the income statement right away. Okay. Under the other one is called absorption costing. Under absorption costing, the fixed manufacturing overhead cost is considered as a product cost. Okay, it's considered as part of the manufacturing cost. It has to go to the inventory first. Okay. Are we clear with the difference? Okay, 1, 2, 3. If you are clear, sum up. This is very important conceptually, right? You have to understand the difference between these two costing. Okay, I will say that again. Okay, I will say that again. The difference between the two costing is how they treat fixed manufacturing overhead cost. Under absorption costing, that is treated as product cost. Okay, it's part of the manufacturing cost. And that will be included in the inventory. Okay. Under the variable costing, it's treated as a period cost, just as expenses, goes to the income statement directly. Okay. Hayden, you have a question?
Yeah. So how for absorption costing, how would fixed manufacturing costs get onto the income statement? Like how would your utility bill make it that way?
Yeah, when the product is sold, right? When the product is sold, it will be a cost of goods sold, right? So that's when they reach the income statement.
So then, so like if your utility costs are 1 month or now, and the product doesn't sell for 6 months, do you have to go back and look at how much utilities were 6 months ago to record that, or how does that work?
Yeah, so that there are certain portion already sold, right? Those product has been sold. That cost, a portion of the cost already been recognized in the form of cost of goods sold. The other portion would be in the ending inventory, in the product that unsold.
Okay.
Yeah. I will show you an example. I hope it will be much clear. Okay. So this is important, but I will show you one example, and then you tell me if you are okay with it or not. Okay. Absorption costing, the product costs are capitalized as inventory. Okay. And the period cost expensed. Okay. So this is also referred called the full costing. Absorption costing has another name called full costing. Oops. And the variable costing, okay, so the product cost does not include fixed manufacturing cost, okay? It also has another name called direct costing. Okay, so this is the difference. You can see under variable, the income statement will be like you have a revenue, and then you minus variable cost, and you have a contribution margin. And then you minus fixed cost, you get your operating income. For the absorption costing, you have revenue, and then you have cost of goods sold, okay? And then the difference is called the gross margin, and you minus operating expenses, you have operating income. So you can see that if you read the income statement, just by the way how they structured it, you should know that which method they are using. Are they using variable costing or absorption costing? I have a question for you. Do you think, what's the requirement under IFRS and ASB? Do you think they require variable costing or absorption costing?
Absorption.
Absorption? Yeah. So if you go to the online, download the financial statement of the public companies, right? You will see this revenue, cost of goods sold, this format, right? Not this format, because IFRS and ASB require absorption costing, okay? And then what's the difference here, right? What's the difference between these two? Is how they treat the fixed manufacturing overhead. And the variable, this overhead, fixed overhead, is considered as a fixed cost, okay? Under the margin, contribution margin. For the absorption costing, the fixed manufacturing overhead is part of the cost of goods sold. That's above gross margin, okay? So I will make a, I think I have an example. I hope that will be pretty clear. When you use different costing, your result, operating income will be different, right? The amount of the difference between the operating income under the two approach is really locked into the inventory, okay? So the inventory change, the inventory cost change really reflects that difference. If I just read this sentence to you, you won't understand. But I'm going to give you one example, and then you'll be very clear on this, okay? Okay, this is my example. Okay, this is my example. Suppose this is the first year of a corporation. Okay, first year. They have a fixed cost, fixed manufacturing overhead cost, $10. Okay. So if it's a variable costing, where this $10 ended up? If it's a variable costing, tell me, if it's a variable costing, where this T, who is T? Let me see. You check who?
The income statement is expressed in the income statement.
Yes, right. You can see this is the expense, right? In this container, this is the expense. So this under the variable costing, your fixed overhead cost $10. We'll just run through, okay, just run through into the income statement as expenses. So your expenses will be $10. Let's assume in that year, your revenue is $20. Okay, so 20 minus 10, that's your expenses. The operating income is $10. Okay, $10. Under absorption costing, this $10, fixed manufacturing overhead cost, will go through a portion of that will stay in the inventory, and a portion of that will go to the expenses. Okay, so basically we are saying 20% in this case, 20% of the production, okay, is unsold. Okay, and 80% of the production in the first year is sold. Okay, so the 80% of the product, they bear 80% of the cost, which is $8, right? So now this $8 is the cost of goods sold, right? That's in the income statement. So my operating income would be $20. That's my revenue minus my cost of goods sold, $8. So my operating income is 12, right? So then you wondered, what about the other $2 fixed manufacturing overhead? Okay, that cost is considered as the product cost, right? The 20% unsold. So if that product is not sold, where it is? If the product is not sold to the customers, where that product stays?
Ending finished
Ending
goods.
inventory.
Ending inventory. Ending inventory, right? So, you know, so the $10 fixed manufacturing overhead is for the whole year's production, right? So if 80% is sold, so that will be, those products will be allocated for $8. That is converted into a cost of goods sold, right? So that's how the $8 is ended up in the income statement. While the 20% unsold, right? They are sitting at the inventory, right? The inventory cost will have part of that fixed manufacturing overhead cost, right? That's why that $2 sits at the inventory. Okay, so think about this as a pipe, right? The liquid does not run through completely, right? A portion of that is stored by the inventory. Okay, only $8 runs through into the income statement. So in this case, you can see the operating income is different. Okay, under absorption is $12. Under the variable is $10. Do you have any questions on this picture? Robert?
Hi there. Will absorption always be bigger when it comes to the ending operating income?
Very good question. Therefore, I have prepared another slide after this one to show you a different example. Yeah, very good question. Yeah, I will show you on the next slide, okay? Yeah. For this slide, does this make sense, this picture? Let's see, 1, 2, 3, go. Okay, very good. Yeah. So now I will give you a formula, okay? So the difference between the two income, if you use absorption operating income minus variable costing operating income, that should equal to the fixed manufacturing cost in the ending inventory minus the fixed manufacturing cost in the beginning inventory. Okay, why don't you test on this? Use my example to test if this equation is correct. If you already tested, let me know, okay? So use my example to test if this equation is balanced. Let me know once you have your result. Okay, Rain.
Both of them are just 2.
2, okay. So what's the absorption operating income?
It was 12.
Okay, minus what's variable operating income?
10.
So 12 minus 10 equals, what's the fixed manufacturing cost in ending inventory?
It was 2.
And the beginning inventory?
0.
0. So 12 minus 10 equals 2, and 2 minus 0 equals 2. Okay, see? So now with this example, it's accurate. And so Robert was asking a very good question. So let's see the second year. This is the first year, okay? So let's take a look at the second year. Second year, I use a different color. So the second year, the fixed manufacturing overhead cost is $8, okay? And I use a different color, $8. So once again, under the variable costing, that $8 goes to the expenses directly, okay? So the revenue, suppose, is still $20. What is the operating income under the variable costing on the second year?
12.
12, yeah. So 20 revenue minus the expenses 8, 12, right? Okay, let's see absorption costing. And you see this picture, right? There are $8, okay, and 7 ended up in the expenses, and $1 is in the ending inventory. Where does this red one come from? This $2 red color, where this comes from?
Last year's ending inventory.
Yeah, that's the last year's ending inventory. Those products will be sold, right? So those products sitting at the ending inventory last year is sold in the second year, right? If you think about the FIFO, first in, first out, those items in the ending inventory of year one will be first sold, right? First in, first out in the second year. So that's why that $2 now was in the cost of goods sold, right? And for the current year, I use a different color. I use 7. I use green. You can see, 7 out of 8. That percentage of production of that year is actually sold, and there's only $1 fixed manufacturing overhead cost sitting at the ending inventory. Okay. So can you tell me what's the operating income for the year 2 under absorption costing?
11.
11. So so the expenses would be 7 plus 2, right? So that's 9, right? And 20 minus 9, that's 11. So my operating income is 12 for variable, and my operating income is 11 for absorption. So Robert, did I answer your question?
It's a great answer.
Awesome. Okay, awesome. Okay, now why don't you test on this equation? You test on this equation again using the numbers for year 2. Yufeng, did you get the answer already?
No, actually, I have a question. But,
okay, go ahead. Yeah.
So if the inventory cost the determination method is the weighted average instead of FIFO, will it change anything in here? In first in, first out.
So this one is actually a manufacturing business, right? Sorry, I should not use the first in, first out. When you have a merchandise business, right, you are purchasing inventories, right? In that case, you are saying first in, first out, right? But this is not a merchandising business. This is a manufacturing. You are not buying inventories from other people. You are making those inventories, right? So in that sense, yes, you always sell those items, the old items first, right?
Oh, okay.
Yeah.
Thank you.
So who have the answer? Test on the equation. Okay. Mikako?
Yeah, that's -1.
-1. Okay. How did you do that?
So 11 minus 12.
Okay. Yeah. And
And that's the 1 minus 2.
Okay, 1 minus 2, right? That's correct. So 11 minus 12, okay? So that's 11 minus 12 equals, the ending inventory is 1, right? The opening is 2, right? So on both sides, it's minus 1. Good job. So you can see that the difference between the operating income under the two costing is really about the change of the fixed manufacturing cost in the inventory, okay? Do you think you remember this formula? If there's a question in the final exam on this, would you know this?
Yep, because I'll put 5 stars beside it.
Okay, good, good. Okay, I want to see if this makes sense after this example. Okay, so tell me if this makes sense. If you understand the difference between the two costing. 1, 2, 3. Sum up. Okay, wow, pretty good. Awesome. Yeah, if you don't understand, please don't feel shy. Just ask me, okay? Okay, so that's the difference in the operating income. Okay, so now I want to ask you a question, just to test if you really understand it. Okay, I want to ask you a question. Okay, so this question is about how do changes in inventory cost affect operating income? Okay, the first question is, if production equals sales. If production equals sales for a year, the operating income will be, what's the difference between the variable costing and the absorption costing? Are they going to be the same, or maybe one is greater than the other? Okay, so if the production equals sales, tell me about it. So
The same.
participation. Okay, so who hasn't participated yet? So raise your hand. Inka?
I think it'll be equal.
Why?
Because the production and sale at that time they're the same.
Yeah.
I'm trying to see how I'm going to explain it.
Yeah. How about you use the formula? See if you can use the formula to explain it.
Yeah, so if I use the formula you just gave, the absorption costing operating income minus the variable costing operating income. Not that one. Yeah, I think I might have.
Yeah, but your answer is right. Okay, your answer is right. So
okay.
There's no difference, the operating income. Good job. Your instinct is right. Yeah. So let's see if somebody can give me an answer technically using the formula. Let's see, Samarin.
Well, I think it is because there is no difference in beginning and ending inventories.
Okay. So because
of that, operating income under like both the thing, it becomes same.
Okay, yeah. So basically, there's no change, right? There's no change in the inventory, right? Your ending inventory is the same as the beginning inventory, right? So if you produced 10 units and you sell 10 units, how does your inventory change? You sell exactly the same amount of the production, right? Does that change your inventory? No, right?
No, it doesn't change. That's why it's same, right?
Yeah, let's say today you eat 2,000 calories, okay? Today you eat 2,000 calories, and you consume 2,000 calories. Does that increase your weight? Or does that lose your weight? If you consume exactly the same amount of the energy you take in,
Then there's no change.
there's no change, right? So therefore, your ending inventory is the same as the beginning inventory, right? Right?
Yeah. So
So
that's what
then-
I said. Is that
Yeah.
like what I said is correct?
Yeah, your side is correct.
Okay.
Then-
Okay.
So I'm sorry, I'm trying to elaborate on this. So then you use the two balance, the difference will be 0, right? Okay. So this is equal. Okay, now my question is, what if the production is greater than sales? Which is the costing is greater? Which is the income is greater? You check who?
So if the production is greater than the sales, the absorption costing will be greater than the variable costing because of
Okay.
the ending inventory.
Ending inventory will be higher, right?
That's correct.
Yeah, because now you are saying that you are producing more, right? You are producing more than you can sell. Okay, so you are gaining weight. You are gaining weight. So that means your ending is greater than the beginning. So this difference is a positive number. So your absorption operating income will be greater than the variable operating income. Does that make sense? Okay, what about production is less than sales? Which one is greater? Which costing will have greater operating income? This question is given, right? You know the answer. But you
Should
still
not
don't want
be-
to answer. I don't know why. So that would be it's still the same two students, okay? They have already participated a lot. So basically, okay, so Bianca?
Yeah, it's, it's too easy, right? So
Yeah.
the variable cost will be very higher than the absorption.
Yeah, very good. Okay. So make sure you know this, right? Make sure you know this. Okay, so are we clear with this? If you are clear, sum up 1, 2, 3. Okay. Okay, so I will move on. Okay, so if you are a manager, okay, your boss tell you that you get a bonus if the company achieve certain level of income, maybe $1 million. If you are the store manager of Walmart, right? Maybe the headquarters will have some kind of incentive plans for all the store managers of Walmart. If your net income of the store reach $1 million, you get a $50,000 bonus. Okay. So here we are saying these managers may want to manipulate income to increase that income so they can receive the bonus. Okay. How can they do that? How can they make the operating income look better?
Putting more ending inventory.
Pardon me?
Putting more in ending inventory.
Yeah. Very good. You have very good memory. Yeah. So basically, here, just give me 1 second. So we just did this one, right? So we talked about which method we are using for the IFRS and the SB. Which of these two methods we are using for SB and IFRS?
Absorption cost.
Absorption costing.
Absorb.
Yeah, if I want the operating income to be higher, which one I should go? Which method I should go?
The middle one?
Yeah, the middle one, right? This is how I can make it higher. How can I make it higher? Production more than sales. Okay, production more than sales. So if I'm the manager, I'm going to ask my people to produce a lot of more units. Okay, even though I know I can't sell it, right? But by doing so, I'm going to have a very large ending balance. Okay, inventory balance, right? Because I can only sell so much. When I overproduce these items, they will sit at the ending inventory, right? So at the end of the year, I'm going to have a very large balance of ending inventory, and that ending inventory will absorb a large portion of the fixed manufacturing overhead cost. So that means the amount of the cost goes into my income statement is low, right? If the cost is low, then my income is bigger, right? So then that's how can I bump up my income, right? That's how the way I do it, okay? So when I overproduce, okay, and a large amount of that will sit at the ending inventory, right? And they will absorb a large amount of portion of the fixed manufacturing overhead cost, right, of the year. So only a relatively smaller portion goes to the income statement as the cost of goods sold, right? That lower the expenses and increase my income. Okay. Does this make sense? Can I share with your bonus in the future? I teach you a trick.
Yes, teach us a trick.
Okay. Okay, so unfortunately, the CEO is also very smart. Okay, the CEO will be wondering, how can we deal with this? Do you have an idea how we can deal with this? So we all know now, we all learned that this is the trick people will play. How can we deal with this?
You can regulate how much you have in inventory, your inventory size.
Okay, yeah. Wonderful, yeah, for sure. That'll be one way, right? You want to make sure that you don't have a lot of items on the inventory. Robert?
Production quotas.
Production quotas, okay, yeah. Anybody else?
I want to say like auditing, like audit.
Okay, so more supervision on this, okay. So right now we are saying that this is about performance evaluation, right? When you achieve a certain target, you get a bonus, right? And we are talking about absorption costing, right? Okay, think about it. There's going to be something else can be helpful. You learned more than absorption costing tonight.
Possible for internal book, they use the variable costing.
Yeah, very good, right? Well, very good, right? For external reporting purpose, the company have to rely on absorption costing, right? But performance evaluation is for internal function, right? Nobody will stop you from using variable costing, right? If you use variable costing to evaluate the manager, do you think they will still overproduce the sales? Sorry, overproduce the products? No, they will not, right? Okay. Does that make sense? So for external reporting purpose, you have to use absorption costing. But since performance evaluation is an internal thing, right? So you can definitely use variable costing, right? Does that make sense? Is there a problem using variable costing?
Would that increase the cost though? Because it's a complete different costing system.
Yeah.
Do they have to do a total complete different calculation and inventory and stuff?
Yeah, the benefit is you can kind of eliminate that manipulation by managers. But like you Feng said, that's gonna be actual work, right? So now you have to have two costing numbers, right? You have to do the two sets of numbers, right? There's additional cost, right? Do you think managers can manipulate income under the variable costing?
Sure.
How?
Make big sales.
Make big sales? Okay.
I meant fake sales, like just anyways.
Yeah, maybe you can have like promotions, right? So, and December promotions, huge promotions, right? And even though that's just a superficial kind of a benefit, because in January people will not buy, right? So you are kind of
have a bunch of
Mhm.
have a bunch of employees like buy the product and then return them after the period that year end.
Yeah. What about the underproduce? If they underproduce, this is higher, right? Do you think they want to underproduce to make it a higher operating income under variable costing?
During a slower season, you might.
Just in general, they probably will not do that, right? Because they still want to meet the sales demand, right? They want to make sure that they are able to, meet the sales to maximize their operating income, right? To reach their bonus target, right? So they will not underproduce, right? Okay, so are we okay with this? Okay, 1, 2, 3, go. Okay, good. Okay, so the one way we just talked about it is that we are going to use variable cost. Okay, the bonus will be based on the numbers on the variable cost. Okay, and the bad thing for that would be you have two sets of figures, right? It's more time consuming. Okay. For Appendix 9A, I don't want to talk too much about it. It's a interesting costing, right? In addition to the just give me 1 second. So somebody has to mute yourself. Sandeep, this is the second time. I think you opened your. If you have a question, you can just ask, right? Raise your hand, ask. Otherwise, you don't have to turn on your microphone. This is the second time I heard noise from your background. Okay. So in addition to the absorption and the variable costing, they also have something. This Appendix 9A introduced the super variable costing. Okay, so under this super variable costing, they only include the direct materials. Okay, that's pretty interesting, right? Okay. Under Appendix 9B, you must know this formula from 2400. So that's how to calculate the break-even point, right? You use your total fixed cost and plus the target operating income divided by contribution margin per unit. That would be your break-even point. And I taught 2400. I know I have done a lot with my student on something like this. Okay. And this formula for the absorption costing is break-even is more complicated. The one you have seen is the variable costing, right? Break-even point. This is the absorption costing break-even point, and you can see it's more complicated here, right? It's more complicated, this formula. If you find this interesting, maybe you can just read through it. Okay. Okay, so I need to maybe have a time break, maybe 10 minutes time break. And coming back, I will cover 2 questions and then we are done today, okay? So let's take a 10 minutes break and then coming back, we have 2 questions. I hope I can finish very quickly. Okay, we'll see you soon.
I mean,